Welcome to Soboco Insights. In this session, we will be discussing employee benefit plan, control weakness, and deficiencies. Hi, my name is Brad Muniz. I'm the partner in charge of the insurance practice at Soboco. With me today is Matt Charney, supervisor in Soboco's insurance practice. Matt, as part of the audit process, we're required to review and evaluate control weaknesses and deficiencies. And we may find them in our planning process, as our walkthroughs, or as part of their substantive procedures we do. And if we find them, we're responsible to report them to governance.
That's right.
Now, as it relates to employee benefit plans, I'm sure people are saying, they're going, what kind of control weaknesses can they have in employee benefit plans? I imagine you're going to have a few that you're going to tell us about. So
That's right.
Let's jump right into it. Which deficiencies are most common for benefit plans?
Right, and that's a good place to start. And thanks so much for having me here, Brad. The most common deficiencies that I want to hone in on today include 4 different ones that I'd like to talk about. First is a late employee or employer contribution remittance. Second is a failure to auto-enroll an employee or auto-escalate their contributions. Third is a failure to properly apply forfeitures. And fourth is a failure to cash out terminated employee balances. So let me break all these down so everybody watching knows what we're talking about here. Late employee and employer remittances really deal with the timing that the remittances get into the plan. So that means once you're pulling the funds out of payroll, there's a time limit to when you can actually move that into a fund. Now, that can go wrong in a few certain ways, in which maybe you're not matching the employers or the employer match equally throughout every employee. Maybe the deferral rate across all the participants is not matching what they've elected. Maybe you've had a lag in between when payroll was run and when the funds were remitted to the plan. Either way, these are considered late, and the DOL has very specific rules saying if it's not as soon as administratively possible, now it's considered a late contribution, and you're going to have to make corrections by reimbursing the employee and also going through a process called lost earnings, but we'll get to that later.
Real quick, I just want to say, these are employees' funds.
Correct.
Okay, the DOL, Department of Labor, is very particular about this. This is money that does not belong to the company anymore. These are the employees' funds, hence the reason they want this remitted into the plan as soon as administratively feasible.
Yes.
Which we could talk about forever, but go ahead, I'm sorry.
Yes, we could do a whole video just on late remittances. That's how important it is.
Right.
And to reiterate what Brad is saying, it's very important that the employees that are pulling their own funds out of their own paychecks need to have those funds placed where they want it. It's not up to the plan sponsor. And so moving on, a failure to auto-enroll and auto-escalate is another great topic to go over, because many plan documents will say that new employees who come in will be auto-enrolled into the plan once they reach a certain eligibility date. It's easy to miss these eligibility dates if you're not tracking the birthdays, hire dates, certain terms laid out in the plan document so that everyone is enrolled when they're supposed to be. Auto-escalation, on the other hand, is for existing participants who have already been contributing, and now their deferrals are going to automatically come up at a certain point in the year. It's easy to miss that if we're not paying attention. All of a sudden, the year might go by, and now the plan sponsor hasn't been remitting enough from the auto-escalated deferral rate, and you have lost earnings again. Next comes a failure to properly apply forfeitures. Now, the forfeiture account, I think we all know what forfeitures are. It's when someone is not vested in their account, they leave or are removed from the plan in some way, and now those funds are now forfeited, and they move from the personal account into the forfeitures account. These are still funds that technically belong to the participants. It's not for the plan sponsor to use however they want. It's laid out within the plan document, and there's very specific ways that plan sponsors are allowed to use those funds. That can include using it to help fund an employer match, using it to help fund the fees that the plan administrator will charge to the plan sponsor. The key rule to remember here, though, is that those need to be used within the year that they're allocated. If you're waiting and not using them within the year, it could jeopardize the plan's tax status. And I have a whole list of things that we'll get to later about how important and how crucial that is. Lastly, and admittedly a little bit less severe than the other 3, is the failure to cash out terminated employees. a lot of plan documents will say that either under $5,000, $1,000, if you have a balance of that, a balance around those amounts in your account, and you now leave the plan, you're automatically supposed to have those funds cashed out and provided to you. And a lot of plan sponsors do miss that, and they end up missing those termination remittances.
And what happens, we find out a lot of times is the requirement to have an audit, the 120/100. I'll let Liz Harper and everybody else talk about that deeper, but sometimes if you cash some of these people out, that may bring you back below the 100 or the 120 that requires an audit.
Right.
So
Exactly.
they should keep in mind of that. So if we do find significant deficiencies or control material weaknesses, we're responsible to communicate that to governance, formally communicate it in a letter to governance.
Correct.
Now, for commercial entities, they have some loan documents that say if you get these material weaknesses or management comments, also known as, you have to let us know what they are.
Mm-hmm.
Government agencies, nonprofits, they have certain reporting that they have to do if there's findings also that go directly to the government also.
Mm-hmm.
Right now, there's comment that this may be part of the financial statements at one time, or some reporting that the DOL will find about. Right now, they don't go. It doesn't go to the DOL.
Mm-hmm.
But what are the effects or the ramifications of these deficiencies?
Yes, so there's a few effects that we need to keep an eye out for, and there's a reason that all the auditors are keeping their eyes out for these kinds of things. One that we already mentioned that I'd like to go into more detail now is lost earnings. So say your employee remittances are late, maybe you normally do them within 2 or 3 days, and all of a sudden you're doing them now within 7 days. That means the participants who were supposed to get those funds within 2 or 3 days are getting them later and invested later than they normally would. Now what does that mean? Normally you would say, okay, I've put those funds back into their account, everything's okay, right? But because they're funds, they're always moving up and down based on the market. If there happens to be a benefit in the time between when the funds are supposed to be remitted and when they're actually remitted, that raises the value of that fund, that benefit is now missed by the participants that did not get their remittances on time. That is now the responsibility of the plan sponsor to put back into the plan, and there's a process that they'll have to go through to calculate all of that. And the IRS does provide various types of programs depending on the severity of how much was missed, how late it was, called the self-correction program, other types of correction programs that they might be able to use to correct that.
Now, the market may have gone down, but that's all well and good, but it's not the sponsor's purview to sit there and determine when the money should be contributed and not contributed for good earnings or not. Put the money in and let the plan do what it's supposed to be doing.
Exactly, yeah. No one here is trying to time the market. We're here to save money, and that's what we should be doing. I would like to point out as well that if you fail to auto-enroll or auto-escalate your employees, you might also be responsible for lost earnings in those scenarios as well. That's because if a participant is supposed to be auto-enrolled on day A, but not enrolled until, say, day B or day C, now those days where the contributions are supposed to be flowing into the plan are still missed. So before we mentioned that if you're not properly applying your forfeitures, it could jeopardize the tax status of your plan.
Go ahead.
I did bring a list of effects that could mean for the plan, and I wanted to read them out specifically because there's quite a few of them. And it could mean that under Revenue Ruling 80-155, the participants are forced to recognize contributions as gross income, employer deductions might be limited, the plan trust could owe income taxes on the trust earnings, rollovers might be disallowed, and contributions could be subject to additional taxes such as Social Security, Medicare, federal unemployment. So as we can see, there is a long list of issues that could come about if your tax status is jeopardized. So it's really important to make sure that those forfeitures are being applied within the year that they're earned.
So it's not just, okay, hey, the plan's not a 401k anymore, it's not a qualified plan. There could be monetary impact to individuals and the plan itself, tax-wise.
That's true, your participants and the plan sponsor themselves.
I didn't even know about those. Thank you for that. Wow.
Yeah, you're welcome.
I'm going to go talk to our administrator, see what they're doing.
All right, and lastly, if there are some participant balances that have not been cashed out because of those termination cash outs that we were talking about, Admittedly, again, this is a bit of a less severe effect, but you could be out of compliance with your own plan document. Again, there are some programs that the IRS offers for plan sponsors to go through and fix that up, but depending on the severity of all that, there could be some lasting effects. And as Brad mentioned before, certain amounts could be brought down below the line where an audit may be required. So you might be doing an audit when you don't need to.
Now, we're not attorneys here. We're not acting as attorneys. We're not ERISA attorneys in any way. I want to make sure people know that. But they should be talking with ERISA attorneys. They should be following the plan guidelines,
Right.
because the last thing you want to also have is a potential for a lawsuit from a former participant, maybe even a current participant, saying that you were not acting in fiduciary manners.
Right.
I've dealt with ERISA attorneys. They tell these are not pretty lawsuits, because the Department of Labor more often than not will side with the participants.
That's true.
So in our last few minutes, we have what type of controls can they put in place to help prevent some of this? It's not absolute controls, but at least some layers.
Right. Yeah, it's not all doom and gloom. There's a lot that we can do to put in place controls that will prevent these deficiencies from occurring. So say the issue that you're most concerned about right now is the late remittances. What we can do to prevent that is initiate a reconciliation process. So what does that mean? That means you have a control preparer and a control owner. The preparer will take a look at all of the payroll information that needs to be put together before the payroll run is made. Now, that'll involve obviously checking the salaries and hourly rates and that all the hours are matched, but also looking to make sure that election deferrals, employer matches, anyone who needs to be on payroll is included, anyone that needs to be enrolled in the plan is enrolled in the plan, checking all of these things and making sure that it's all in order and aligned with what the participants have elected and what the match criteria is before payroll is run. Once it's run and there's a mistake, it might be too late and you'll have to scramble to make sure that it gets fixed. There are ways that you can automate things like this if you work with your bank, your plan administrator, your payroll provider, ways to make sure that those deferrals are coming right out and they go straight over to the plan administrator. It's all automatic, it's calculated by them. That can be great. Otherwise, having a preparer put that together and an owner to review everything is just as good. The next item and the next control is really dealing with the auto enrollment. Now, reconciliations are great for checking to make sure that everyone's enrolled, but the other thing to take it an even step further is to make sure that all of your participants' demographic information is correct. So their hire date, their birth date, things like that you might think, oh, why does that really matter for the plan? Well, depending on their age and depending on how long they've been working at the company, that could affect whether they're eligible to enroll in the plan or not. And if you're missing those eligibility dates, and that could go on for months and months on end, all of a sudden you have lost earnings that you need to make up for close to 6, 8 months, maybe in a year, depending on when you're actually checking it.
Right.
So it's important to look at that almost every pay period, especially when someone is hired. All of that information should be recorded. Now, when it comes to making sure the forfeitures are allocated, the best way to take care of that is to make sure that you have someone, again, a control preparer and a control owner, who's monitoring that forfeiture account, taking a look at all the activity that's coming in, and making sure at least once a year it's being rolled out into the use the plan document says it can be used for. In addition to that, it might be a good idea if you have a board or someone who's responsible for governance to take responsibility of that forfeiture account. Again, losing your tax status can be a really big impact to your plan, to your participants, to your sponsor. So we want to make sure that everyone is tuned in and making sure that that account is moving in the way that it's supposed to be. Lastly, if you'd like to prevent the failure to cash out your terminated balances, all you need to do is make sure that you have a control preparer and a control owner, again, someone to perform the control and to review it, to look at anyone who's been terminated each month and take a look at their account balances. Were they enrolled in the plan? If so, are they under that limit? If so, we have to make sure a distribution is made. I want to point out, it's not quite enough to make sure that the distribution is made. You need to make sure the distribution is successful as well. A lot of times, employees leave because they're moving, they're making changes in their lives, their contact information changes, their address changes. All of a sudden, you send a check to their old address, it doesn't get to the employee in time, they've already moved, it's sitting in the mailbox, maybe it goes back to the post office, the distribution wasn't successful, it's still sitting in that account, it's going to come up if somebody looks at it and says, hey, this participant was terminated, but their balance is already still there. So I think those are the best ways that we can really prevent these kinds of things from happening.
And some plans have it, they will automatically roll it into an IRA too.
Right.
And that still takes it out of the plan then.
You can
So
do that.
Yeah, I said before that we're not ERISA attorneys, but we are accountants. And the one thing that we can give good, confident information on is that reconciliations and review are the paramount processes to have in place
Yes.
for good controls.
Yes.
And that's the one thing we'd recommend. We as your auditors can't do them for you, but we can help advise you as to what you can do. And then, as I said before, we look over them as it relates to part of the audit process. So, Matt, I want to thank you for all this information. There's a lot of information that you gave us.
Thank you so much for having me.
And I want to thank you for watching Sobelco Insights. Please visit our YouTube channel for additional videos.